Hello, have you ever been in that situation that you follow all the investing rules but you still cannot make money? So, if that is the case, this video is for you. 5 reasons why index fund investing is still the best alternative out there. First of all, we will identify all the frequent investment mistakes and then explain how an index fund investing is the cure that you're looking for. Okay, so without further ado, let's go for the 5 main investment mistakes. Number 1, buying high and selling low. Fidelity made a study on their Magellan fund run by Peter Lynch from 1977 to 1990. His annual return was on average 29%, which is one of the best returns ever over a long-term fund. Therefore, you would expect that investors in his fund made a substantial returns, but what we found is that actually the results were tragic. The average investor in that fund that had 29% average actually lost money. How? How is that even possible? Well, investors would pull their money out of the fund during periods of poor performance and send it in during periods of good performance. So, in other words, they were buying high and selling low on a managed fund. And that is what most investors do. Take a look at the screenshot of a Dow bar research and the gap between the S&P 500 and investors. Number 2 biggest mistakes: performance chasing. Investors who chase performance are highly likely to lose money over the long term. All they are doing is looking at a list of mutual funds and choosing the one of or few that are performing the best and putting their money there. Last year, winners are often next year's losers. Therefore, it's wise not to chase returns exclusively. No one can predict for sure which asset will be the best or worst performing asset in a certain year. Number 3, gambling. Many people think that they can make money by winning the lottery. If it was easy, then everyone would be a millionaire. Would you go to a casino and gamble the money you're investing? If you say so, then I advise you to make a small experiment and play poker for $100. How we act is often different than how we thought we would do. If you deny the question above, then why do you gamble when investing? Number 4, peer comparison. This is a common strategy by people who don't know what they are doing with their investments. You might decide to ask one of your coworkers what he or she is investing in, or you may look at, one of those investing influencers on TikTok or YouTube. But if you don't know anything, then how could they possibly know less than you? Although it's possible that their coworker is a savvy investor or that one of those influencers hit big, the odds are against it. Another example of this is friends comparing their returns to each other and then having FOMO, fear of missing out. For instance, when you see someone profiting marvelously from cryptocurrencies just before its collapse, whilst an investment strategy might work for one person, it might not make sense at all for another. There are so many variables, such as timing, allocation, and frequency, that make this a complex issue. Number 5, news-based influence. Paul Andreessen, a psychologist that ran many experiments which show that paying close attention to news can lead investors to trade too much and to earn lower returns than those who tune out the news. Everyone now has access to the news 24 hours. If you are a day trader, this might be relevant to your daily activities. However, most investors are long-term focused, or they should be. If your investing time frame is long-term, you should largely ignore the daily news. That also includes channels on YouTube that gives you daily news, by the way. A number of successful investors such as Warren Buffett actually prefer to locate their offices away from Wall Street. Even traders such as Nassim Taleb claim he would rather read philosophy, such as Seneca, than the news, even though you could say that the news would impact his job. Furthermore, the news is sensationalist and is already what happened. If it is already happened, then it will not benefit your investments because the market would have already priced in the news to the stock price. Whenever playing the market, you need to know things that not everybody knows, otherwise, it's already put into price. Lastly, the news is frequently wrong. Whether it's because the news stations try to get the story out there quicker than their rivals, or that a reporter is influencing a story with their personal opinions rather than the facts, it happens all the time that news are distorted. So, summarizing, there have been many studies done which show that index overperforms 96% of all actively managed funds. Many successful investors will leave all their inheritance for their families through an index fund. If it is good enough for them, then it might be good enough for you too, you know? As you can see, investing is all about doing things that most other people don't know. And there are companies who are investing billions of dollars to try to get as much information as possible. Think hedge funds like Bridgewater or Renaissance Technology, they have the smartest people in the finance sector spending a lot of money and at the same time acquiring a lot of information. So, if we were going to compete with these guys, we should be applying the same amount of diligence. Obviously, you and I can't because we don't have the resources. But what we can do is index investing. Index investing is honestly the smartest move for 99% of the investors because it will weight considerably higher on the companies that have been winning and therefore they are in the momentum to win. And it diversifies your portfolio by reducing the risk as much as it can by having 500 different stocks, for instance, in the United States market. And if you want to diversify even further, you can acquire different indexes, not only for the US, but also for other parts of the globe. And that is it for now. But I hope you enjoyed this video. If you did, give a thumbs up and subscribe to the channel. Thank you.